Great. Hi, everyone. Welcome to the Net Purpose webinar, where we're going to talk about impact investing in 2023. We're just going to give everyone a few minutes to make their way in, and I'll pause while we do that, and then I'll provide some guidance and kick us off. Hi, everyone who's joining us. Just to say thanks for sparing your time and spending it with us today. We're going to give everyone 1 minute and then we're going to kick off. Alrighty. Welcome everyone to this amazing conversation. We're going to talk about impact investing in 2023 today. I'm Sam, founder and CEO of Net Purpose, and I'm going to facilitate, I would say, this exciting conversation once we get these technical pieces ironed out. Just a few housekeeping notes before we kick off. So the first thing is that this webinar is being recorded. We hope that's okay with everyone, and that we actually can't see or hear anyone in the audience unless we purposely unmute you. So we're going to do our best to make this super interactive, and what we're going to do is encourage you to comment, write questions or anything in the Q&A chat at the bottom of your screen. So just localize that so that you've got it. There's a Q&A button that you'll need to press to write a comment or a question for the panelists. Don't press the chat button, press the Q&A button. The other thing is we're going to keep some time at the end for questions, again, to make this as interactive as possible. Awesome. So super excited to have everyone with us today. And I just wanted to say, to kick us off, that I'm Sam, founder and CEO of Net Purpose, and I'm actually really honored and delighted to be surrounded by such an incredible group of people today to talk about impact investing in 2023. Just by way of brief introduction, I've been in the impact investing industry for a number of years now, and have had the privilege of co-building a little bit alongside a lot of the people around this table today. In starting Net Purpose, we've really been on a mission to make impact measurement effortless for investors, to try to tackle one of the toughest challenges of impact investing today. But this hour is not about Net Purpose. It's really about enabling us to all learn and think about the year ahead and what's on the horizon for working on impact in 2023. I will say that it is a very exciting time, and I'm going to say a few more things about that in a minute. But before I kick us off, I might just ask our panelists to introduce themselves. And I'll start with Sarah, and then ask Neil and Ashby to say hi as well.
Thanks, Sam. So I'm Sarah Wilson. I lead ESG integration at Nuveen, which is the asset manager for TIAA. We are focused on helping our investment teams integrate ESG factors into all of their investment decisions that they make, to help us better manage risk and enhance performance. And we also help design the roughly $45 billion in ESG and impact funds that Nuveen offers to our clients. Maybe about a quarter of that is in what we would call impact investing strategies. So happy to talk more in a minute about some of the trends we see around that slice of the market in particular.
Thanks, Sarah. And Neil.
Good, everybody. Good to be on this call. And I'm a researcher, and I teach sustainable finance and impact investing at Johns Hopkins University here in Washington, DC. Before that, I had a long career with IOC, where I led the development of operating principles for impact management, and I continue to advise and research around impact management and measurement and the mobilization of private capital.
Amazing. Ashby.
Hi, everybody. I'm Ashby Monk. Thanks, Sam, for inviting me. I'm excited to be here. I've been focused on long-term investing for, I don't know, the better part of 20 years. I run a research center at Stanford University, and it's really focused on the world's biggest investors, the asset owners, pension funds, sovereign wealth funds, endowments, foundations. And for the first decade of my career, it was really focused on design, governance, management, decision-making. I would say the second decade has tilted much more towards data, information, analytics, and the tech stack. Outside of Stanford, I also run a research team at Adipar, which is a software company here in the Bay Area in New York, actually around the world now. And I'm just really excited to be here to join this conversation.
Amazing. Thanks so much, everyone. And I know we're surrounded by many people around the world today who are equally thoughtful on impact and impact investing, or maybe you're just starting your journey on sustainable and impact investing and wanting to learn more, but really excited to chat through key topics and what's happening in 2023. So without further ado, just to kick us off, just to frame this conversation, I will say that it's quite an exciting time for impact investing, with a couple of key things happening around the world, really. And for me, having been in the space for a while, it really feels like the momentum is picking up, but also that we're tackling a lot of key challenges that have been sitting there for a while and that they're really coming to the fore. So I'm just super inspired by the fact that the Gin last year put the size of the impact investing market at $1.2 trillion in a research report that was actually supported by Nuveen, Sarah, which is fabulous to see, which is an enormous leap forward versus the early days, I think, when we were talking about wanting to get to $1 billion and that being a big, hairy, audacious goal. So the size is there. I think regulation is also a very interesting topic at the moment. The UK in particular has just launched guidance around the definition of sustainable investing and impact investing, and really trying to define the difference between the two, which I think was a great step in the right direction. Maybe needs a bit more refinement, but it's coming into the mainstream, basically. And then finally, I think for us at Net Purpose, we've just been so privileged in our early years of our journey to work with such passionate, thoughtful investors who are literally mobilizing billions and trillions to achieve the SDGs. And personally, I'm just really excited for this chat to learn a bit from all of you and the audience around the table on what's on the horizon for 2023. So with that, what we have asked everyone around this table to do is to prepare a few thoughts on what is on the horizon for impact investing in 2023. And Sarah, I might actually ask you to jump in first. You're at the coalface of impact investing, if I might say, among this group, actively working on this every day for clients. Tell us what's on your mind for 2023.
Yeah, thank you. Interesting choice of metaphor, the coal face. But anyway,
It is true.
No, I am really excited about what this year will bring, and I think it's characterized here at Nuveen by kind of two things coming together that we see as complementary, but also in some ways distinct. So one is just a relentless focus on helping clients meet what are, I would say, rising expectations around sustainability and positive impact, seeking real world outcomes through their investments alongside competitive financial returns. So, we always have to kind of set the stage and make sure people know that we don't think those things are mutually exclusive. We see the potential to achieve both with our strategies, but clients are demanding more and more. They're demanding more evidence, more transparency. And I think that gets back to kind of the data question, and a lot of what we're trying to do is enhance the data and reporting that we put in front of clients to help them get confidence that what they thought they were getting when they invested with Nuveen through an impact strategy is in fact what they're achieving, what we are achieving with their money on the ground. The other side of the equation is around the increasingly complex regulatory regime that we have to operate within. And, I think that what we've seen come out of the EU through the Sustainable Finance Disclosure Regulation, or SFDR, has been kind of the first mover, right? So they've been out there with a framework. Is it the best, most perfect framework? Probably not. I think we all have a lot of, now that we've kind of lived through implementing SFDR as an asset manager, we have a lot of things that we would probably like to improve about it. But setting all that aside, it is the first attempt to look at sustainable funds and even impact funds in an apples to apples kind of standardized way, and apply a systematic disclosure regime on top of those funds that will let clients understand more clearly what they're getting. And I think that has huge implications for the industry. So we just came through a pretty important milestone for SFDR, where all funds that were labeled as Article 8 or Article 9, which is essentially the ESG and the sustainable investment objective strategies, had to disclose by the end of last year their approach. And part of that disclosure was not just a bunch of narrative and sort of website stuff, but it was also optionally putting a bunch of data into a template, the European ESG template, that then gets picked up by Morningstar and by other data aggregators. And so that actually had, in our experience, now 2 months into 2023, that had a huge impact on clients' ability to look at our product offerings, compare them to products being offered by our peers, and then actually start to say, okay, which one of these funds aligns or doesn't align with my preferences on sustainability. And that is just, I think, you can't kind of underestimate the level of game-changing nature that has for our space, which has been plagued for so long with kind of swirling definitional questions and questions about terminology and how do I really understand what this product is. So I really see that as this disclosure regime kind of matures and we see more information being put out for funds marketed in the EU, I think it's just going to ratchet up the level of rigor that funds will need to demonstrate to gather assets. And I really think that this kind of focus on outcomes and clients looking for that information, it would just become the conduit for that information will become much kind of faster. It's sort of a superhighway for sustainability and impact information. So I'll stop there, but that's where we're seeing big movement this year.
Amazing. It's actually quite astonishing to think. And I will just point out that you actually sat in New York. So this, even though it's a European regulation, has had absolutely global ramifications. And you've been proactive on complying with that since day one. So I've been, on the international regulatory front, not just US regulatory front, given the presence of your offerings. And great points, by the way, too, on outcomes and alignment. I do want to come back to that in a minute, but thanks, Sarah. Really appreciate it. I might just ask Neil now to jump in with your thoughts, Neil, on impact investing in 2023.
Great, thanks. And I'll build on what Sarah said about regulation in a minute. But first, just to give a little bit of sort of financial markets context, I think that while the case for investing for impact is becoming more compelling for more investors, that the financial markets context is maybe going to introduce some headwinds that maybe weren't there in the past few years. Was to getting from 0 to $1 trillion mostly happened against the background of very low interest rate environment and investors searching for yield. So when they were looking at competitive financial returns, they were in an environment where the market benchmarks were fairly subdued. As we all know, the market has really changed substantially over the last year. We're looking at a higher interest rate environment into the medium term. I think as a result, you see that big impact funds from big asset managers are still able to raise funds, even at bigger scale than they have before, multi-billion-dollar funds, which we have only begun to see in the industry really in the last 2 or 3 years. But I think you find that smaller impact funds are going to find it harder to do new capital raises in this environment. So, it's going to be a phase, I think, where everybody's going to have to up their game a bit, both in demonstrating that they can achieve competitive financial returns and being more credible in what they can deliver on impact. And I agree with Sarah about the increasing us in terms of the data around impact. Interestingly, there was a study from some data from Cambridge Associates last year, which showed that in developed markets, the returns on private equity impact funds are now about the same as they are on other impact funds. So that performance gap, if there ever was one, we can now demonstrate it no longer exists in developed markets. However, there is still a gap between the financial performance of impact funds in emerging markets compared to other private equity funds. So I think there's still a challenge there in attracting capital for impact in emerging markets. And that's only going to be made harder for US dollar investors. With a very strong US dollar, it's also that's also depressing returns in other currencies. So that's also going to make it harder. So I think, there's a lot of sort of structural changes which give momentum to impact investing, but cyclically, I think it may be a tougher market. And so, as I say, everybody will have to raise their game. And then secondly, just building on what Sarah was saying about regulation, I think, the EU has been in the lead. The US was a little bit missing from action under the last administration, but that's changing now. And, the SEC has draft naming rules, as you mentioned, the UK does as well. And so it's going to be a little bit of a complex environment over the next year, because the naming rules between the EU, the UK, and the US are not entirely the same. And there are some things to like about all of them, but none of them really quite cover everything. So, for example, I like the fact that the SEC is proposing that impact funds should disclose their impact measurement process. We've always thought that was important, and it underpins the operating principles for impact management. I like, as Sarah said, the data transparency requirements for Article 9 funds. But the concern there, I think, is a little bit, again, for funds which are investing in emerging markets. There's a bit of concern that the data disclosure requirements may actually deter investors from trying to invest in markets where it's harder to get that data. So I think it's moving rapidly. I think the US is now going to catch up with the EU and other jurisdictions like the UK. So it's going to be a bit messy over the next year or two, but I think the direction of travel is very positive, in that we're moving from this era of self-regulation with all the dangers of impact washing and greenwashing that went with that, to now the regulators are stepping in and setting some clear rules for the game. And I think for those investors that have been on the frontier of good practice in this area, that's positive for them, because it means that now others are going to be required to meet the same standards. I'll maybe leave it there for now, Sam, and I can come back in on a couple of other issues if time allows.
Amazing. Thanks, Neil. Regulation is such a big topic. I'm going to come back to that as well. And it marries nicely with what Sarah was saying for clients and actual funds. Ashby, though, let's hear from you on impact investing in 2023.
Yeah, sure. Well, it's stormy here in California, and I think it's been stormy for most of 2023. It feels like we've been flooding. And that, to me, is what it feels like being a fan of ESG and impact investing here in the US right now. It's stormy here. We're not exporting fabulous regulation around the world. We're sort of exporting fear and outrage about the ESG space, which is unfortunate, right? I think if 2023 goes down in like the history of impact investing, it will be like that pivotal year where we make the real strong case to the mainstream that there's something valuable here. That this is not just a fringe element of the investing space that can be ignored in the way that many, U.S. governors and U.S. state treasurers are attempting right now. This is really about, true understanding of the portfolio. So 2022, we began to realize that there was a rejection happening here in the US. A lot of that had to do, I think, with the underlying data that was powering these ratings. Because collecting this data is very hard, we have to build an entire infrastructure around collecting impact data. We don't have, the Edgar filings like we do for traditional financial data. We used ratings. We use ratings to communicate general principles of sustainability, of impact, and those ratings are difficult to use for investment decision making. And they revealed contradictions. The classic one is Elon Musk complaining that Tesla and Exxon have the same rating. And so that type of like a quote or moment in the media was really grabbed onto by political forces, which have now raised the idea in the minds of my community, pension fund CIOs, endowment CIOs, that ESG might be something that is fringe, that impact investing is something they might be able to ignore. And I hope that coming out of 2023, we've kind of put that to the side and revealed to everybody that this is really about different lenses of understanding. So just as when you're, looking at your Google Maps or your Apple Maps, you have different little maps you can click on. Do you want the satellite view? Do you want the traffic view? Do you want the roads? All those different views of your map, I think, are akin to the different views you can look at your portfolio. Do you want the traditional modern portfolio metrics, Sharpe ratios and mean variance optimization tools and things like that? Or do you want impact metrics to really understand what your portfolio is doing in the world? That, I think, is going to really power this new era of decision making. And part of it, and this is to my final point, is going to be underpinned by this shift towards data-driven decision making. So I told you in my little opener that I spent the first decade of my career thinking about the governance of pension funds. What a fun person I am at cocktail parties. Governance and decision-making at public pension funds. I'm actually teaching a class on that at Stanford this spring, if you're interested. And so, but if you think about the way we design the decision-making process, it was really about putting excellent people together around investment committees, around boards of directors, in order to assess what information we had and make smart decisions. So we relied on experience, we relied on track record, we looked for PhDs, CFAs, Kaya designations. We really relied on people. And that was because we didn't trust the data. Data, when it becomes granular and reliable, actually powers new information and new knowledge. And you can see that in the way that I talked about Google Maps. Most of the people out there won't have a paper map sitting in their car anymore. They're not going to be effective navigators. And if someone next to you were to say, hey, I know a shortcut to get to where we're going, you would say, what are you talking about? Let's just follow Waze. Waze is the data-driven equivalent to the person who knew a shortcut. In finance, we are moving from that I know a shortcut mentality. That's modern portfolio theory, capital asset pricing model. Those are the shortcuts, by the way, 70 years old, dust off your textbooks, but they're still being used. We're going to move from that world with the shortcuts and the old models and textbooks into this world of Google Maps for finance. And I think the impact investment space is going to add that context and granularity to the different layers of understanding. And that's where I think this goes truly mainstream, where this no longer becomes around investors wondering how they make the world a better place. Obviously, that is a big part of impact investing. But I do believe that the impact investing movement becomes a way for every investor, pension fund, sovereign fund, to granularly understand their portfolio and think about the resilience of the portfolio that they've built to achieve their future objectives. That was a lot of info. I'll go back to you, Sam.
Thanks, Ashby. I love it. And I also love your energy. Thanks for bringing it. So actually, just on that point, I did want to say for everyone in the audience today, the people around the table are amazing, as you've just heard. I'm privileged to have this conversation and to learn from all of you. But it's also really interesting because you all take very different lenses or have different perspectives on this space. So Ashby was just talking about resilience. And I really love this concept that like every company in the world has an impact, which is, I think, something that we have understood as an impact investing community, and that the measurement of impact can actually help you understand your portfolio with a whole new lens, whether you're an impact investor by definition of intentionality and theories of change and others or not, which is quite a relevant concept to every investor in the world. In addition, I think like the perspective that Neil, having built the IFC operating principles for impact management, Sarah, Nuveen, obviously a leader in building impact and sustainable and ESG strategies that span the whole remit of those strategies, have different perspectives on this topic as well. So I was going to maybe pose a question, given I'm the one asking questions now until others chip in, and please, audience, please do chip in. Impact measurement. So Sarah, for you, like how effortless is this today? Maybe on a rating of 1 to 10, but also where are we at with it? And like, what are your data challenges, or do with that question what you will, but the general topic of impact measurement, where do you feel like we're at, and what are the big data challenges for you?
Yeah, so I mean, on the topic of impact measurement, I agree with Ashby that eventually we get to a place where impact data is used not as just a validation for strategies that have an intention to make a positive impact on the world, but rather as another lens or another input to the investment process. And actually, I think we could talk a little bit about how that's already happening with certain themes, like the theme of climate and carbon. But on the process of actually measuring impact, I would say that right now it's very bespoke. So it's very specific to the investment that is being made on the ground, whether that's a private equity investment in an emerging market or a public fixed income investment here in the US. And we're very dependent on the willingness of the issuer or the portfolio company to disclose and share information that allows us to then aggregate and repackage that in an impact report for a client. And I think that just makes for a very inefficient flow of information. It means that the same, if there's Nuveen that's trying to get that information, then our peer asset managers are all doing the same thing, going out and getting the information at the same time. And, I see that's really where, some of our partnerships, like the partnership with Net Purpose, can come in to help make things a little more efficient. But I don't think we're all the way there yet. I think there's still a huge reliance on kind of the grassroots bottom up way of surfacing this information. And on the flip side, when we try and sit in the seat of the client and think about what the client actually wants from us, it's not, 35 different metrics from the the iris library or whatever, right? Necessarily. It's a much more cohesive story that's backed up by a couple of reliable data points that bring to life what's going on the ground. And it's really our job as Nuveen to try and walk that line, right, of gathering up the information that's out there, but then also really just curating it, I guess is the word I'm searching for here. And I think we're only at the very early stages of what that looks like. And I think that that's only happening for intentional impact strategies at the moment. I don't think that that level of curation or thought process is going into how we think about impact in a broader sense across all of the investments that we make.
Thanks, Sarah. Neil, did you want to jump in on that one?
Yes, thank you. I think this is a key issue in terms of the future credibility of the impact investing space, which is what's going to be needed to continue to attract and scale the amounts of capital. I think the first step was getting credibility on the investment process, and that's what we put in place with the operating principles for impact management, and that investment process was independently verified and disclosed to investors so they could really see for themselves and in a credible way how an investor was going to use an investment manager was going to use your money to have impact. I think the next step now is to apply the same transparency and credibility to the data quality. You know, that I think in the first generation impact funds, investors were just happy to get any impact metrics at all. The next frontier, and I think Sarah already alluded to this, is people are getting more demanding and asking questions about the quality and the provenance of that data. And where we are in the industry today is that most impact reporting, it's self-reported data from company without any assurance, and then the aggregation into impact reports by fund managers is done without any external assurance or audit of those numbers. We actually put in place, when I was at IFC, we had an external assurance by our auditors of all the data in our annual report, and we were one of the very few other DFIs or investors that did that. But I think there's going to be increasing demand from investors to have that kind of externally verified, credible data. So I think that's going to be a big trend in the industry going forward. I think we've made the most progress with climate data, where there's been a lot of progress in defining what the key climate metrics are. And there's a lot of science and a lot of rigor behind how you measure those metrics, and that maybe that was one of the easier places to start. But I think that's provided a bit of a template that we need to expand to other areas. I think a key risk area, I think, for the impact investing industry is when it comes to reporting on social impacts. And the risk is that we report on social impacts and claim benefits without involving the beneficiaries. I think we're vulnerable today to criticism that we're defining impact sitting in London or New York or the Bay Area or DC, where I am. And I think, again, to be credible in the long run, reporting on social impacts has to include the voice of the beneficiary. And there are methodologies and techniques to do that have been developed, but again, they're not widespread across the industry. So I think that's the second frontier. And then the third point I would make is that we're also on a journey from what Sarah described as very bespoke metrics to standardization. And, we've made some progress in the industry in that most impact funds and DFIs select indicators from the IRIS Plus data set, but there's a couple of thousand indicators there. So it's a starting point in harmonizing definitions, but it doesn't give you much beyond that. And it doesn't align you with what the corporates are reporting themselves. So I think for the industry, it's also important that we connect to the work in progress. That's a multi-year process. It's not going to happen overnight, but the work that's in progress with the International Sustainability Standards Board to start to work towards a common global standard for corporate reporting. So the long-term vision is that I think impact investors will be able to select metrics that corporates are reporting on a consistent way rather than having to go and ask for metrics that they're not already set up to report on. That's going to reduce the transactions costs for corporates, it's going to reduce the transactions costs for investors, and it's going to make impact assets more comparable for investors when we start reporting using consistent metrics and metrics which are credible and have good data quality behind them.
Thanks, Neil. Couldn't agree more. And by the way, I think one of the early insights that we had when we started to unpack the data challenge was exactly that, that there seems to be different standards for different audiences, because GRI is really the globally accepted, well, the standard that listed companies use, I would say, more or less. And what's prescribed by GRI is basically what you see most of the time in company reports and public disclosures. The GRI audience, though, is very different, like companies, to impact investors and IRIS Plus. And it feels like there's a coming together of standards that were built for different audiences, but are ultimately saying the same thing, which is why really encouraged by the work of the ISSB. And I do think standardization will probably be a big topic in 2023. Just to pick up on the topic you said about social impact, and then I'm going to come to you, Ashby, with some questions here that have come in from the audience. But a topic on social impact and a question from the audience. So thanks, Letitia. Really happy for your question here. Interesting that you're an analyst on the Columbia Threadneedle social impact team, and thinking about metrics like number of students put into education, which IRIS Plus might classify as an output metric, or potentially an outcome, depending on the type of students. But you're not satisfied necessarily with that, or should we be satisfied with that, or should we be really trying to get down to the intended impact and whether that education has had a positive effect on those students? There's a great company called 60 Decibels who does a lot of this work, Tom Adams, who used to be at Acumen, and I wondered if Sarah, Neil, or Ashby, you had any thoughts on that topic.
Well, I can kick off. I mean, I think two things. One, I think, yes, we have to go beyond output measures, but that doesn't always mean that each individual investor has to do their own research into the connection between outputs and outcomes. I think to some extent that research is a public good which needs to be shared across the industry. I think it's very inefficient today when I see individual fund managers trying to pull together a couple of RCTs or academic papers and do their own analysis of, if I educate 500 girls, what's going to be the effect on their income or health status. I think there's need for collaboration at that level of understanding how outputs lead to outcomes and ultimate impacts. And the second thing I would say, using this example about students being educated, is that if you're not asking the students themselves about how they benefited from that learning, your assessment of impact is not complete, and you can apply that to every other field as well.
Yeah, I would chime in here and just say that I think it really varies by asset class, what level of capability we have to go deep on outcomes. And while I do think it's laudable to push in that direction, and we have, I sort of neglected to mention earlier when Neil brought up the operating principles for impact management, and Nuveen, whenever we put the word impact in the name of a fund, it has to be verified against the operating principles for impact management. And that harkens back to, at the early stage of that initiative when we were a founding signatory. And, we feel strongly that there's a need to buttress our practices with this kind of third-party verification against best practice. But I do think we have to be realistic about what investors and asset managers can really do individually. I think in the private markets or in working with some of the supranationals like IFC, there's more capacity for those studies, that research, reaching out directly to those populations. I think when we're trying to unlock, especially the public markets for impact investing, I'm not sure that it's realistic to think about that level of evidence at this point. I do think that like most things in impact investing, the private markets tend to be a bit of a bellwether for the direction that the entire industry will go. But there's a real need, I think, to just go where we're like meet these sort of investment opportunities where they are, and not overlook opportunities to invest through public fixed income or public equity, as long as those are paired with rigorous process and rigorous verification against a third-party standard like the one that the IFC helped put together.
Yeah, I would agree with that. And I think that may be the reason why we landed on a set of output indicators at the Gen with Iris Plus, because there has to be something, as you say, Sarah, for the client to make it simple and understandable without getting, then it's probably a journey, right? Of like step one, actually get to measuring, for example, number of people with access to education. Step two, hopefully the investor is already measuring how that's benefiting lives, but to roll it back up to a portfolio view would be quite a lot of data points to digest amidst a whole host of others. We've got some good questions coming through, so I'm actually just going to take it back. So Ashby, there's some great questions coming through on this concept of impact being a lens on your portfolio.
Sure.
And I guess, can impact be viewed as a financial imperative going forward? Where are we on how asset owners look at that, or where are we, do you think, on that?
Yeah, I think it can be. I think we need a postmodern portfolio theory, which sounds like big words, but I think it's important to understand that we as an industry don't understand what resilience is yet. The yet is key. So in other, I'm in an engineering school at Stanford. Resilience is a thing that we've got very well defined and talk about all the time. It's the ability to recover from a shock, absorb and recover. Ecosystems, psychology, human performance, that notion of resilience is very common. If you go and look in our industry, you will see the word resilience a lot. But what they're talking about is robustness usually. Robustness is actually quite different from resilience, and we need to move beyond robustness in order for the impact world and the ESG world to really drive performance. 1 minute on this topic. So robustness is immunizing yourself from shocks. The shocks happen around you, you don't feel it. Your portfolio doesn't move. We use derivatives, we diversify our portfolios for correlations of asset classes. We've heard of all weather funds. All those topics are about robustness. The minute we realize that robustness actually doesn't consider the recovery profile of the things we're investing in, the light bulb should go off in your head. Recoveries are critical, but as investors, we don't have risk metrics today. This is shocking to say, that will tell you as investors what the profile of a recovery would look like for a specific asset. Obviously, it's a critical thing. If you get submerged underwater, it's not how deep the drawdown is, how deep you go underwater after the wave crashes on your head. It's how long it takes you to get back up to get a breath of air. It's the combination of drawdown plus recovery that we know intuitively is critical. But we don't have any of the methodologies or tools today in the industry, except for impact investing, in order to really begin to understand the recovery profile of our assets. Now, Dane Rook and I are in the process of inventing resilience portfolio theory. But what I'll tell you is you don't even need to wait for our amazing papers. You can do this intuitively. If you think about diversity, equity, and inclusion, broadens perspectives of companies dealing with a crisis, gives them the context to make creative responses and recover faster. Ethical sourcing, build deeper and better connections in your community, which stabilizes supply chains in a crisis and recover faster. Smaller environmental footprints protect against sudden regulatory changes, allow you to move your footprint in order to recover faster. Healthy workplaces, same thing, loyalty of employees during a crisis so that you can recover faster. All of these things are the critical parts of impact investing that I think as we're measuring, we begin to understand which assets have a different recovery profile than those that are just focused on robustness. And so I actually think this is why 2023 is so important. We're going to discover this year that resilience really matters in finance, and that it's actually about building resilient portfolios. And hopefully everybody is as shocked as I was when we realized there is no resilience in financial tooling. We don't have a volatility, Sharpe ratios, all these things do not speak to the pace or profile of the recovery of your portfolio.
Fascinating. And actually, just a question on that. Do you think we're going to get to a metric? There's one question in here that's as intuitive as classic risk and return metrics, so that we add so.
Yeah, Dan and I just wrote a paper. It's always fun to plug academic papers. You don't have to go read it. It's hard to read, but we defined something called the submergence risk, which seeks to put math around the drawdown and the recovery. Now, that's a first attempt to combine the recovery into our standard metrics of risk. The minute we can find ways, and it doesn't need to be our submergence concept, it can be somebody else's, but the key is to start to begin to pull in the profiles of recoveries from past crises, so we can look at those companies and say, oh, this company has these impact criteria, it's much more likely to recover well. Here's the submergence risk. That type of a metric will really make profound impacts on the mainstream investors' decision-making with respect to portfolios.
Awesome. Can't wait, Ashby. Love it. Fabulous. So just to kick into a couple more questions that we've got here. There's a lot of questions on different types of impact measurement coming through. So I guess on the one hand, we've got outcomes measurement or outputs and outcomes that are prescribed by IRIS Plus. On the other, we have alignment methods that are really prescribed by regulation, a little bit with the EU taxonomy, certainly more focused on percentage aligned or eligible across your portfolio. And then we've got a whole host of questions or topics coming through with regards to real impact, as in step beyond outputs and outcomes. But what about the scientific literature that demonstrates that you're actually having an impact by providing education, or the surveys or questionnaires that help demonstrate among the beneficiaries that impact exists? Three kind of layers of data, I would say, to be honest, also from a practical point of view, and pulling that online, which is what we work on every day. I wanted to ask you, Sarah, you've spoke about this tension between, not tension actually, two trends, shall we say, between what clients really need on reporting and then the regulatory piece on reporting and measuring basically the impact of your portfolio. You also mentioned that outcomes are really important to you and to clients. Can you speak a little bit about like where you see your efforts on like what type of data or measurement you're trying to get to speak to clients? And second to that, is this regulatory push behind alignment a hindrance to measuring outcomes? Or is it just amping up the level of sophistication so that we can continue to focus on outcomes as well as alignment?
Yeah, maybe the last one first. So,
yeah,
I mean, I do think the focus on alignment is, I mean, it's different. It's objectively different from trying to report on impacts, outputs and outcomes from an impact investment. But I think it's growing the tent. So it's pulling in a lot more people who otherwise might have thought of this as just kind of a niche or fringe aspect of investing. And instead it's centering sustainability and green and whatever alignment metric you want to pick, kind of at the middle of why somebody is choosing a particular fund or a particular strategy. And that's, I think what's interesting in the EU is that it's this kind of whole suite of regulation that's had that effect. So it's not just SFTR, it's not just, the corporate disclosure requirements. It's that in combination with the requirements that clients must be asked about their sustainability preferences under MiFID II. And if the client says they have a preference for sustainable fund, they have to be presented with a set of options that show alignment metrics and information about the sustainability of those options. And so when you think about like shopping and other types of products, if you're in the grocery store, it's like all of a sudden the nutrition label has just been created and you're able to go in and say, gosh, I can now look at my Triscuits versus my wheat thins and make an informed decision based on calorie content or whatever I care about. And, that I think just changes the game. And so I do think when we're focusing on putting alignment information out there, it's almost like the gateway drug to impact in some ways, because you get information about sustainability. And then the question becomes, oh, well, how does that align? Like what kind of climate scenario maybe does that align with? Or what's the carbon footprint of that fund? And what kind of impact might this have on indigenous populations where these investments are located? And what's the nature loss associated with these assets? And that's my wonky RI self going down that rabbit hole. But I think as people get a little bit more familiar with this, they know what questions to even ask. And so, I kind of see it as that progression mostly. And obviously we're spending a lot of time driven by what's being mandated of us under regulatory regimes, both EU and then later on UK and US. But that's not going to stop us from putting out information on outcomes and impact reporting, because we think we know from having worked with clients that is really where they get the most excited.
Awesome. Thanks, Sarah. The practicalities, though, of implementing these regulations, as well as what clients are excited about. I actually think we're kind of rising up. I agree, putting all of these things on a playing field, and ultimately we'll be able to get more sophisticated by doing so, maybe more. Neil or Ashby, any thoughts on that? If not, I'm going to jump into some of these other questions.
Yeah, I first of all, I love the call of Triscuits. It took me back to my youth. I had to literally Google to be like, are Triscuits still happening? And they are still happening, apparently. They were invented in 1902. Anyway, I grew up eating Triscuits. But I think the point here is we need this version of this organic movement. So I've written a bunch on what we call organic finance, and it's all about labeling and understanding what's in your investment products. And it does replicate those nutrition labels. And I think investors are really interested in getting to grips with what's in their products, especially coming out of the 2008 financial crisis, when we were just wrapping things, literally we use the word wrapper, to go back to food analogies. We would wrap things up and we would diversify them. You wouldn't even know what was in it. If you could figure out, what was in your CDO or any of these other asset classes, you're a superstar with a PhD. And I think that does replicate some of what we saw in the food industry over the last 30 years, as we really got granular with understanding what's in our food. And we've seen the rise of entire grocery chains that are all about understanding with what you're consuming. And so I love this concept of building standard nutrition labels on top of our products. And I think that's an interesting analogy for this impact space. Yeah.
Maybe I can just mention something related to this on the subject of labeling, which is in the fixed income space. I think we saw a lot of growth in green and sustainable and climate and social bonds. And I think there've been good progress in terms of defining what those different labels mean. But at the same time, I think people have come to feel that use of proceeds bonds are often a fairly weak instrument for actually financing change in the firm they're investing in. That often you may just be financing the things that are already green or meet the label, or even refinancing in some cases. So there's been a lot of interest, I think, in the market in sustainability linked bonds, where instead of the use of proceeds being what you rely on for the impact, you're relying on improvements in some KPIs which apply across the whole business. But I think what we're seeing over the past year is, first there was a big increase in appetite and increase in issuance. Then we've seen a bit of a pullback as people have realized that first generation of sustainability linked bonds actually had quite weak mechanisms in terms of the incentives for issuers to actually achieve those KPIs, or the penalties if they don't achieve them. So I think it's a model which has lots of potential. I think investors are more interested in seeing change across the whole company than exactly where their dollar of proceeds was spent. But I think the next generation of sustainability linked bonds, you're going to have to see a sort of an increase in ambition in terms of what issuers commit to, and either the penalties or the structure of these bonds to make sure that they really do deliver on incremental performance against KPIs.
I can jump in on that a little bit. So we're big investors in, especially the sort of in what we call the impact bond space, so green, social, and sustainable bonds based on use of proceeds. And we definitely we hear the criticism sometimes about, are these instruments actually additional? Are they moving capital beyond what would have otherwise been allocated? And I do think that the growth in that market suggests that there is a push toward companies directing capital spending toward these projects in ways that maybe it would have happened, but maybe it wouldn't have. And it's certainly true that being able to show clients that look through to how their money is being directed towards direct and measurable impact through specific projects, that's not possible without the sort of use of proceeds market and the way that it's evolved. I do think on the sustainability linked side of things, I totally agree with you that the kind of weakness of the mechanisms within those structures has been concerning. We have, as Nuveen, we have not typically selected those sustainability linked bonds for impact mandates because we are not sure that those KPIs are aggressive enough, but it certainly is a structure that could mature in a very positive direction. So, I think we would hope to see, especially as a tool in the public markets, where something like that is an efficient way of trying to push a company in the right direction. That becomes more over and above what, the company might have been planning to do anyway.
Amazing, guys. So we only have 2 minutes left, and we have so many other questions that we didn't get to. So we can also follow up on these posts, but there's just one left that I'm going to ask you guys for your input on before we summarize. And I'm going to give you a couple minutes to think about it while I summarize a couple of key threads. The question is, what do you think the impact investing market needs to be able to grow this year? Just think about that for a minute and ask for like 1 or 2 words on that topic. But just to draw a couple of threads, I think there's some really strong lines actually coming out of this for what impact investing holds in 2023. First of all, I've loved this concept of clients, first of all, really demanding this data. Sarah, the fact that people get excited about the impact and illuminating the impact of their portfolios is amazing. And Ashby, to your point, if we can measure the impact across all portfolios, that helps you ID what's in there, like what's in this portfolio of mine that I didn't know, and how is it having an impact on the world? it does feel like regulation is clearly a topic that's going to be around for this year and coming years. And as we figure out where that lands, I think over this year, it's going to be an interesting time. But I do think it seems that a lot of this group is linked into that and seeing that actually as a positive step forward, rising the sophistication of the space. And then the third thing on measurement that's been really interesting out of this chat is these different types of measurement coming out: alignment, outcomes, science, direct beneficiary surveys. I think we need to simplify that a bit, or at least make it such that everyone could measure everything over time, but that we've got a comparable way to do so across funds. Because I think the fourth thing coming out for me, which is really exciting, is this concept of labels, that like a Trisket, the Trisket of impact investing for 2023. If a client can look at one fund versus another and quickly say, I know what that is and I know what that isn't, that would be an enormous step forward. We're out of time, but maybe just to quickly, one word or two from each of you on what impact investing needs to grow in 2023.
I think we need role models. I think people in this industry follow each other around. And so just like we have the Yale model and the Canadian model, we need impact role models to come out and show what they've done, how they've done it, what the performance is, and why other people should copy them.
Awesome. Thanks, Ashby.
I'll say engagement with regulators. I think the regulators are not trying to kill the industry with regulation, they're trying to help it grow. But those of us who are in the industry, whether the asset owners or the asset managers or service providers like you, Sam, need to be educating and engaging with the regulators so we improve the quality of regulation, so we don't have the unintended consequences of regulation, which isn't helpful. But I think people want it to be helpful, but they need the voices of the industry to get there.
Awesome.
I'll stop and end with more options on the shelf. So people don't want to walk into a store and see one dusty little impact fund on the bottom shelf, right? They want to see a lot of options that meet with things they care about. We didn't talk about customization or any of those things that are other big trends in the space, but like just more to choose from. And back to our labeling conversation, ways to compare what you can pick from too.
Amazing. Fabulous. Thanks so much to all of you and to everyone that's joined today. Thank you for sharing your time with us and your questions and comments. And if you have any more questions or want to follow up, please ping Claudia at netpurpose.com post webinar, and we'll look forward to the next one. Thanks, Neil, Sarah, and Ashby. It's been a pleasure spending an hour with you.
Thank you. I'm going to go eat a
Thanks,
Trisket.
everybody. Goodbye.